Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. We are from Group 10. We'll present financial ratio analysis based on two companies. First, Aeon company, and second, Mr. DIY's company.
Introduction for Aeon. Founded in 1758 by Okada Sosema in Kyoto, Japan, Aeon began as a small kimono silk trading business and has grown into a leading retail and financial services corporation. Over 250 years, Aeon expanded through mergers, creating large shopping malls and retail outlets across Japan. It successfully entered markets in Asia, China, and other regions, operating supermarkets, hypermarkets, convenience stores, and specialty shops. Aeon also offers financial services like credit cards, banking, insurance, and consumer finance integrated with its retail operations. Embracing the digital age, Aeon invested in e-commerce and digital technologies to enhance customer service and engagement.
Mr. DIY, founded in July 2005 in Kuala Lumpur, Malaysia, has grown into a leading home improvement retailer in Southeast Asia, offering over 20,000 diverse products across thousands of stores in Malaysia and neighboring countries. The company's success is built on making home improvement accessible and affordable through efficient supply chain management, strategic store locations, and competitive pricing.
For liquidity ratio, there are two ratios under it, which are current ratio with formula current assets divided with current liabilities, and quick ratio with formula current assets minus inventory divided with current liabilities. For Mr. DIY Group, it shows a great performance for current ratio, which is 2.23, but a quite bad performance for quick ratio, which is 0.54. It indicates Mr. DIY Group relies a lot on inventory. For Aeon, it shows a quite bad performance for both ratios, which are for current ratio 0.51 and quick ratio 0.14. Based on the liquidity ratio just now, it shows clearly that Mr. DIY outperforms Aeon. But how did they do it? What's the strength that Mr. DIY has? So to discover this, we use cross-sectional analysis. For the strengths, Mr. DIY has a strong liquidity position with a current ratio of 2.23, indicating its ability to meet short-term obligations effectively. The company excels in inventory management and holds a dominant position in Malaysia's home improvement retail sector. It has achieved substantial sales growth through aggressive expansion. From weaknesses, even though Mr. DIY beats Aeon, it doesn't mean that Mr. DIY doesn't have any weakness. So for weaknesses, Mr. DIY's quick ratio of 0.54 reveals a significant reliance on inventory, posing potential cash flow risks. Additionally, the company is heavily dependent on the Malaysian market, making it susceptible to economic fluctuations and inflation, which could impact its stability. For Aeon faces significant liquidity challenges with a current ratio of 0.51 and a quick ratio of 0.14, indicating difficulties in meeting short-term obligations and heavy reliance on inventory, which could threaten its financial stability. In terms of traits for Mr. DIY, despite a strong current ratio, Mr. DIY's quick ratio, which is 0.54, indicates a substantial portion of current assets tied up in inventory. Disruption in the supply chains, such as shipment delays or inventory shortage, could impact liquidity by restricting product availability and delaying cash inflows. For Aeon's low liquidity ratio suggests potential difficulty in quickly converting assets into cash to meet short-term financial obligations. This exposes Aeon to financial vulnerability, especially during economic downturns and periods of reduced consumer spending. For opportunities, for Mr. DIY's strong liquidity position provide opportunities for expansion into new markets or segments. The company can utilize its readily available fund for capital expenditure and market entry costs, facilitating organic growth or acquisition. For Aeon can capitalize on opportunities to optimize its working capital. This could involve negotiating supplier terms, enhancing receivable management, and improving cash flow forecasting to better manage short-term obligations. Improved working capital management can enhance liquidity and financial stability.
Now I will present the efficiency ratio, which also known as asset management or asset utilization ratios, assess how well a company utilizes its assets to generate sales. Firstly, Let's look at the inventory turnover ratio. Mr. DIY has a ratio of 2.20, while Aeon significantly outperforms with a ratio of 4.31. Aeon's higher ratio indicates superior efficiency in inventory management, leading to better cash flow and reduced holding costs. In contrast, Mr. DIY's lower ratio suggests potential inefficiencies in managing its inventory. Next, both companies exhibit a commendable average collection period of 9 days. This signifies efficient debt collection processes, ensuring steady cash flow and minimizing the risk of bad debt. Moving on to the fixed asset turnover ratio, Mr. DIY stands out with a ratio of 2.05 compared to Aeon 0.93. This indicates that Mr. DIY is more effective in utilizing its fixed asset to generate revenue, while Aeon may need to review its asset utilization strategies. Lastly, the total asset turnover ratio shows Mr. DIY at 1.23, outperforming Aeon's 0.79. This suggests that Mr. DIY is more efficient in overall asset management and operational efficiency. Next, I will briefly compare Mr. DIY and Aeon based on their financial management strength, weaknesses, opportunities, and threats. Mr. DIY excels in operational efficiency with higher fixed asset turnover and short average collection period, indicating strong asset management. However, it faces a weakness with lower inventory turnover compared to Aeon, suggesting inefficiencies. The main opportunity for Mr. DIY is to enhance its inventory management practices, which could boost overall efficiency and reduce costs. A key trait is the competition from firms with better inventory management. On the other hand, Aeon's strength lie in its high inventory turnover and effective receivables management, showcasing robust inventory control. Nevertheless, Aeon struggles with low fixed asset and total asset turnover, indicating potential underutilizations of assets. The main opportunity for Aeon is to improve asset utilization to enhance efficiency and profitability. The threat comes with competitors like Mr. DIY who demonstrate higher assets utilization efficiency.
Okay, now we're moving on to the next ratio, which is leverage ratio. Leverage ratio is a key metric used to assess the extent to which a company uses debt rather than equity to finance its operation. It measures the proportion of a company's debt to its equity, indicating how much debt a company is using relative to its equity capital. So, there are three commonly used ratios that fall under the leverage ratio. First, debt ratio. Debt ratio is a financial ratio that provides a measure of a company's financial leverage by comparing its total debt to its total asset. Second, debt to equity ratio. The debt to equity ratio, also known as a DE ratio, is a financial metric used to evaluate the proportion of debt a company is using to finance its asset relative to the amount of equity. So last, time interest end. Time interest end is a financial metric used to measure a company's liability to meet its debt obligation based on its earning. So here we can see the value of a debt ratio, debt to equity ratio, and time interest end. So we can see Aeon has a higher ratio compared to Mr. DIY ratio in debt ratio and debt to equity ratio, different from time interest end, which is Aeon has a lower value compared to Mr. DIY. So now I'm going to explain about a cross-sectional under the leverage ratio. So here we can see from the Aeon side. Aeon have a high debt to equity ratio which stands at 1.81 times. This indicates that Aeon utilized debt financing aggressively to amplify its return on equity during profitable periods. So from point of view of Mr. DIY, Mr. DIY demonstrates financial prudence with a lower debt ratio of 0.51 times, indicating a conservative approach to financing. This reduces the company's dependency on debt and mitigates its financial risk. In addition, Mr. DIY's high time interest earn ratio of 11.63 times highlights its strong ability to cover interest expense with its operating income. So, it is strength. How about a weakness? Weakness we can see from the Aeon side, which is Aeon have a high debt ratio of 0.64 times, which signifies greater reliance on debt, increasing the company's financial risk. In addition, Aeons also have a lower time interest earn ratio of 2.74 times compared to Mr. DIY, suggests a weaker ability to cover interest payment, potentially exposing the company to higher risk of financial distress in adverse conditions. So, it is Aeon. How about DIY? DIY have a lower debt to equity ratio, which is 1.03 times, while indicating a conservative approach may also limit its growth opportunity. Because of that, Mr. DIY may experience lower expansion compared to more aggressively financed competitors like Aeon. Despite its weakness, Aeon has several opportunities, which is their company can capitalize on its higher leverage by investing in high growth opportunities. In other hand, Aeon can consider debt restructuring to optimize its debt structure and negotiate better terms, thereby improving its interest coverage ratio and enhancing financial stability. For Mr. DIY, they can lower their debt levels because it will give a strong foundation for future borrowing if needed, allowing Mr. DIY to fund expansion projects. Okay, so for trades in Aeon, rising interest rate will significantly increase Aeon's interest expenses, further straining its financial resources and reducing profitability. How about DIY? DIY might face a competitive disadvantage in rapidly expanding markets where competitors utilize higher leverage to grow quickly. So from that, they will miss opportunities to maximize returns on equity, potentially resulting in slower growth relative to more aggressively financed competitors. This could impact Mr. DIY's market position and long-term growth prospects.
Next, we move on to profitability ratios. Based on the profitability ratios that I've calculated in those tables, on 2023, it is obvious that Mr. DIY demonstrates superior financial health and operational efficiency compared to Aeon Company. This is because Mr. DIY excels in all key financial metrics, such as gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity. This value highlights that Mr. DIY has stronger cost management, overall profitability, better asset utilization, and greater returns to the shareholders. Next, I will talk about the SWOT analysis for profitability ratios. For the strength, it is obvious that Mr. DIY demonstrates strong gross profit margin, which is 45.36%, indicates that effective cost management and pricing strategies. Mr. DIY also boasts a high return on assets of 15.79% and return on equity of 32.13%, reflecting effective use of assets and strong returns for the shareholders. For the weaknesses, both companies have their own weakness. For Aeon Company, they exhibit lower profitability margins across gross profit margin, operating profit margin, net profit margin compared to Mr. DIY, indicating challenges in cost management and their operational efficiency. And for Mr. DIY weaknesses, they are having high return on assets and return on equity, which might lead to aggressive expansion plans, which they could be risky if not managed well. A higher ROA than the ROE could mean the company is funding growth with debt rather than the equity. Next, opportunities. The SWOT analysis further reveals that Aeon Company has the opportunity to improve its financial performance by implementing comprehensive cost reduction strategies, focusing on optimizing production costs and operational expense. Aeon Company can enhance profitability margins and strengthen its market position. As for Mr. DIY, due to their effective cost management and operational efficiencies, they can streamline its operations and innovate to better compete in the retail sector, thereby seizing growth opportunities in a competitive market environment. For the threats, Aeon Company might face threats from economic downturns that could lead to reduced consumer spending, impacting sales and profitability. While Mr. DIY, higher profitability ratios and aggressive expansion plans can pose competitive threats within the retail industry.
We move on to the market ratio. First, we calculate earning per share, which is the income available to common stockholder divided by number of ordinary share issue. For Aeon Company, we get 0.0818 ringgit per share. For Mr. DIY, we get 0.0594 ringgit per share. Second, dividend per share, which is ordinary dividend divided by number of ordinary share issue. For Aeon Company, we get 0.04 per share, and Mr. DIY we get 0.0280 ringgit per share. Third, we calculate dividend payout ratio. We get the formula is dividend per share divided by earning per share. For Aeon Company, we get 49%. For Mr. DIY, we get 47%. Then we calculate price earning ratio, which is market price per share divided by earning per share. For Aeon Company, we get 17.11 times. For Mr. DIY we get 32.32 times. And last, we calculate dividend yield, which is latest annual dividend divided by current market share price. For Aeon company, we get 2.86%. For Mr. DIY, we get 1.46%. Next, we move on to the cross-sectional for market ratio. We use SWOT analysis. First is the strength, and company strong earning per share of 0.0818 and a 2.86% dividend yield make it a reliable investment for income investors. This reflects strong profitability and operational efficiency. Meanwhile, Mr. DIY's higher price earning ratio of 32.32 times indicates market optimism for future growth, making it a suitable choice for growth-oriented investors willing to pay a premium for future profitability. Both companies offer consistent income streams and attractive returns. Second is weaknesses. Aeon company price earning ratio of 17.11 times suggests it may struggle to meet growth expectations, potentially affecting investor confidence and market valuation. Despite its profitability, it may not have significant growth potential compared to competitors. Mr. DIY's smaller dividend yield of 1.46% could discourage income-seeking investors, making it less applying to those relying on dividends, thus restricting its appeal to a broader investor base. Third is the opportunities. Aeon company and Mr. DIY has significant growth opportunities due to their strong profitability metrics. Aeon company can leverage its higher earning per share to increase market share through strategic investments or expansion, while Mr. DIY can leverage its high growth expectation to expand its retail market by increasing its product line, entering new regions, or improving its online presence. And last is a threat. Economic downturns and changes in consumer behavior pose significant risk to Aeon company and Mr. DIY. Economic conditions like recession and low consumer spending can negatively impact sales and profitability. Changes in consumer behavior, such as online shopping or changing preferences, can also affect sales success. Both companies must constantly adapt to external variables to maintain financial success and investor confidence. Conclusion for the question A is the future financial situation of Aeon company and Mr. DIY depends on their strengths, limitation, and strategic prospect. For Mr. DIY has high liquidity, high gross profit margin, and efficient cost management, making it a strong candidate for market expansion. However, its reliance on inventory creates risk, necessitating more supply chain resilience and inventory management. Aeon company face challenges due to low current ratios and quick ratios and lower gross profit margins, suggesting potential for increased profitability and operational efficiency. To improve financial stability, Aeon company should focus on working capital optimization, cash flow forecasting, and receivable management. Despite these challenges, Aeon company high debt to equity ratio offers potential for expansion.
Now, I will present the question B. The question is, do they have the ability to further grow their companies and be more efficient in terms of generating future returns? Starting with Aeon, the company has strategically expanded its retail space and enhanced customer experience through digital initiatives. Their investment in online shopping platforms and digital payment systems have not only improved the shopping experience but also boost operational efficiency. By integrating digital solutions, Aeon has streamlined its supply chain, reduced costs, and optimized inventory management. This, along with diversifying product offerings, suggests strong potential for future efficiency gains and improved returns. On the other hand, Mr. DIY has impressively expanded its store network, capturing market share with its value for money proposition. Efficient cost management practices, including bulk purchasing and strategic supplier relationships, have helped maintain healthy profit margins. Their use of technology in inventory management and point of sale systems have further streamlined operations and reduced overhead costs. Mr. DIY's strong financial performance, characterized by steady revenue growth and efficient cost management, underscores its potential for sustained growth and profitability. In conclusion, both Aeon and Mr. DIY exhibit the attributes necessary for continued growth and higher future returns. Their strategic initiatives, strong market positions, and financial health provide a solid foundation for future expansion and efficiency improvements.
So, for the last questions, how do you suggest to the board of directors BOD on which companies is worth to be invested by the company? So for me, I consider few ratios as a recommendation to the board of directors. First, from a profitability ratio, Mr. DIY has a higher gross profit margin, which is 18.81%. It is substantially higher than Aeon. Second, from the efficiency ratio, Mr. DIY also leads with a higher net profit margins. Then, Aeon's inventory turnover is higher, which is 4.31 times, indicating faster sales and replenishment. And for the last ratio, which is liquidity ratio, Mr. DIY has a higher current ratio, which is 2.23 times, indicating better short-term liquidity and ability to cover short-term liabilities. So, for my recommendation, Mr. DIY appears to be a more attractive investment due to its superior profitability, liquidity, and efficiency ratios. Mr. DIY demonstrates better financial health and operational efficiency, despite its higher PE ratio, suggesting it may be priced for growth. In contrast, Aeon company might be considered by investors looking for higher dividend income and potentially lower valuation.